My name is
Yep.
Michael Stoller, and I have the fortunate pleasure of having Andrea Himmel, who is the Chief Investment Officer and a principal at Himmel Meringoff Properties. So, Andrea, you've been on the circuit, as I was saying the other day. A couple of seminars, great presentation, a PowerPoint deck, everything over there. So tell me, in your own mind, has the office market returned, or where are we standing? How many people, what percentage of people are coming to your buildings right now? You know,
Sure. So I'll give you a little background on who we are first before I
that's great.
dive into the numbers and the data. But first, I want to acknowledge the New York City Real Estate Expo. I want to thank them for having me. Mike, I want to thank you as always for being my panelist with me. It's always a pleasure to talk to you. I'd also like to acknowledge that it's Veterans Day, and I want to thank those folks for their service to our great country. I am Andrea Himmel. I am Chief Investment Officer and Principal at Himmel Meringoff Properties. We own one of the largest privately held, vertically integrated portfolios of office buildings in Manhattan, as well as industrial warehouses in the boroughs. We are vertically integrated, like I said. We are value oriented in that we seek distressed opportunities, and we are long-term holders of assets. So we were formed 40 years ago, or a little over 40 years ago, by my mom, Leslie Himmel, and Stephen Meringoff. And we were aggressively looking to expand in the office space in New York City. And I'll get to why I think the fundamentals are strong, but or fundamentals will be strong. But we're seeing 60, 70, 75% occupancy in our buildings today. Our buildings are mostly secondary office buildings, in that we're known for going into emerging neighborhoods and early and kind of letting the tides rise. So we were in Harlem in 1979, in Long Island City in 1986, Park Avenue South when it was 4th Avenue, and you could only underwrite to $4 rents. Today, we think emerging markets are by transit corridors, given the flight of residents to suburban areas. So call it Penn Station, Grand Central, strong assets like Nomad, or areas like Nomad and Chelsea. Most of our portfolio is in Nomad, Chelsea, Flatiron. And because our buildings are these smaller floor plate buildings, call it 12 to 20,000 square foot floor plates, we find that our tenants are more nimble in coming back to the office. They don't have to conform to regulatory compliance and legal issues that big financial institutions or legal institutions have enforced. They like that the windows are operable. They can walk to their floors, and they're single tenancy on each floor, so they don't have to worry about the COVID policies of another tenant. We're also a large landlord to WeWork, among the largest in New York City. And when, in the heat of COVID, in the height of COVID, when everyone was at 5 to 10% occupancy, our properties, primarily 1460 Broadway leased to WeWork, was seeing 50% occupancy. So I know we're going to address flex space, but we're seeing pretty good occupancy, and leasing activity has been high. We signed 12 leases in the past few months in our Chelsea Nomad portfolio. Some of them shorter term for smaller amount of spaces, but a lot of them are, regular size leases for 10 years. We signed a 100,000 square foot lease in Midtown West with the city recently that we have partially announced. And we signed a 70,000 square foot renewal and expansion with NYU in NoHo, where they increased the rent from their prior base and also expanded. And that was a 15-year lease. So we're seeing the long-term leases being made, and we're excited about the opportunity to acquire assets that may be performing a little less well over this cycle.
So the question is, are we at a time, is it a landlord's market or is it a tenant's market? because many of the people I talk to say that the tenant is really king today as opposed to the landlord, even though that you've signed a number of leases, but in general, it's more of a tenant opportunities out there.
It's still a tenant's market. I mean, I think the right way to think about it is in an up market, we'll get the rent, and in a down market, we'll get the tenant, but just not on the same terms. So I'll give you an example. In Nomad, where we were doing deals in the mid 70s before with full build outs, we're now in the low 60s, so down 10-15%. And there was a point during COVID when it was really a weaker market, when we were in the 30s and 40s. That's actually more of a midtown number. The overall market in New York City is at about 18% vacancy, and about 30% of that is sublet space. But you have to remember that the historic average is about 12%. So on a 450 million square foot base, you're talking about 81 million square feet vacant, of which 54 is really the average that we should be at. If we think that maybe we mean revert to 15% vacancy instead of 12, then we only have to make up for about 14 million square feet that's on the market that's vacant. So I have I look at lists of tenants in the market, and we can count like near-term needs of about 8 million square feet of space. So, that kind of gets you over a few years to where you need to be in terms of frictional vacancy rate, if you will.
With regard to the tenants, many people have said to me that they believe that we're at a 4-day work week in the office. Okay, not saying that they're working. Have you seen, or what's your thoughts about, the return to work on people working 3-4 days at the office, or are they working 5 days in the portfolio that you're talking about and your friends?
Yeah, so I think 70% of people, so the majority of companies actually prefer to be in the office. That is comprised of 44% who say, I want to be there full time, and 26% who say, I want to be there most of the time. So yeah, we may transition to a 4-day work week. I definitely think there's a hybrid or work from home model that is partially secular in its permanence and lasting power. But most people want connection, creativity, and collaboration that they can only find in a workplace, especially upward mobility for younger people. I think that home design is not ergonomically and it's not set up for work from home. The average residence is poorly configured to support 2 people working from home. And this is especially true in Manhattan, where our tenants occupy smaller dwelling units and pay a lot per square foot. And they need high speed, reliable internet connectivity, efficient and comfortable office furniture, a degree of quiet and privacy, and cybersecurity. That's an issue too. The home office wasn't set up to be as secure, private, and safe as the office place is. Once you also obviously have corporate culture that you can't replicate from home, and the negative impacts on employee networking and innovation in certain industries, especially IT and biotech, could be material, because a lot of innovation in places like Silicon Valley occurs because of serendipitous, informal networking that leads to connections that lead to new business ideas and products. So the main issue that we're facing is the commute. So how will we see that transform demand for office? Well, I think there may be a movement to a hub and spoke model for offices, where maybe we see HQs shrinking in city, CBDs with hub and spoke, like satellite offices in the boroughs or in Greenwich or in Westchester, to allow for that flexibility. And flexibility is the key word here.
Okay, you mentioned WeWork. I was with somebody the other day who has a small brokerage business. And what he said was that as opposed to WeWork, he's in an HQ, and the HQ has this arrangement where basically he pays $150 a month and he can go to any of the HQ offices for 10 days. So basically it's a $15 a day opportunity. The offices all have, good connectivity, safety, the correct furniture, and so on. Do you see more of that taking place in the future, or do you see the traditional WeWork approach where you basically renting by the month as opposed to the day?
I think there are a couple of forms that flex space takes. The first would be managed office. So the scenario here is an occupier has a requirement to move a team, division, or whole city office between 40 and 300 people. They understand the full range of benefits traditional flexible workplace offers, but they don't want to share facilities like break room and meeting room, and they want more ownership and privacy. And this delivers a fully outsourced workspace, which includes all elements of launching and operating an office. It feels like the occupier's own space delivered and managed by a third party. And this is, traditional flexible workspace operators, specialist operators, and in some cases, the landlords themselves. It's a gray area that bridges the gap between a lease and traditional flex space, arguably allowing the occupier to have the best of both worlds. Next, you have flex and core demand, in which the occupant has a requirement for new premises with fluctuating and/or an unpredictable headcount projection. Alternatively, they wish to outsource some component parts of their real estate, such as meeting space or a project team. So the opportunity here is to identify an operator that will partner to enter an asset, and you can either have the tenant commit to less space for its core requirement, and the operator or the landlord launches a flexible workspace location in the same building. And we've seen people like Silverstein do this. Or you could do a full operator commitment in which the tenant commits to anchor the new location and provides options for future expansion space. Then there's reverse flex space, in which an occupant has underutilized leasehold space. So then we see this taking the form of sublease space. It reduces property costs by partnering with a flexible workspace operator to repurpose, making it into flexible workspace. And there may be asset level CapEx that's required. And I'll give you two more examples. One is the hub and spoke model I discussed to reduce the reliance on a single headquarter building and implement a dispersed occupancy strategy. So shrinking the HQ and taking smaller hubs around the city or region. And this allows the tenant to access talent and reduce labor costs in alternative geographic locations. And the final one would be the mobility pass. And this is what you were just referring to, in which an occupier or a tenant has teams or individuals who work remotely or travel frequently. They can work from clients' offices, the road, from home, cafes, different office spaces. And it's a membership to a network or drop-in spaces across the region. And access to professional workspaces can improve efficiency and productivity for the remote workforce. But employees need to have the technology that enables them to work remotely. And that's something that we don't always see. I mean, how many Zoom calls have you been on where someone's on mute and they're speaking, or, someone gets bumped off the network? So we still have yet to see a full implementation of the tech stack for.
What about hoteling?
Hoteling, yeah. So
I mean, and why don't you explain to the audience what hoteling is in your mind?
Yeah, so hoteling is where JP Morgan is doing this, for example, for their real estate group. They have, let's say the team is 15 people, they have 10 desks, and and it's in a certain part of the office. And at any given time, 10 of those 15 people can show up to the office and take any one of those 10 desks. So it allows for 10, employees to work with flexibility, but not lose their sense of community because they're still with their team, but they don't have their own dedicated office or office space.
Right. I mean, for more than the past 2 decades, the accounting firms had been involved with this hoteling.
Hoteling is the oldest concept of the ones that we've just mentioned.
Right. And what's your thought about hoteling?
I mean, would I want it? No, because I wouldn't want to.
No, I'm not saying for you. I'm saying, have you seen it for some
We've
of your
seen it. We've
tenants?
seen it happening, but I think it's not going to be the major predominant trend. I think what we're going to see is landlords offering more flexible leases. So, for example, if you have a 1 million square foot building, you may dedicate the first 5 ground floors to flex space that is either available for short-term month-to-month leases or 1-year leases. When a tenant needs to expand, they can take some of that space. If they're doing construction, they take that space. In smaller buildings, I think it just manifests itself as shorter leases with, just landlords coming to accept the concept that Adam Newman really fundamentally changed the business with, which is shorter term leases, flexibility.
Okay, let's talk a little bit about COVID protocols that you've implemented and what you expect to see with regard to that.
Sure. So I'd say, while work from home has been detrimental to office demand, putting our vacancy rate at 18%, I think a countervailing factor is the de-densification of the office space. So we saw a downward trend in square feet per person since 1990, from 325 square feet per person to about 190. Now it's coming back up anywhere between 250 and 400 for legal government tenants to 200 and 250 square feet per person for finance tenants. I think that, as far as what we need to do as landlords to make our tenants feel COVID safe is think about healthy buildings and think about smart buildings. So tenants are really sensitive to the health of the building. What does that mean? Ventilation, HVAC. If some tenants carry around a monitor to see the carbon count in the carbon dioxide count in the air in their building. At home, it may be 1,500 parts per million. That's really high. So we need to make sure we replace our HVAC systems so that they're using more fresh air. In a typical office building, the fresh air requirement is about 30% in New York. For life sciences, it's about 100%. That's why they're more expensive to operate. But if we can find a happy medium, we need to refit these buildings so that they have proper clean air. Other design trends that are going to be, for healthy buildings are operable shading for energy efficiency, insulating concrete block walls, signage promoting healthfulness, living walls, green roofs and gardens are big, ergonomic furnishings, multi-purpose rooms for fitness or childcare, and the mechanical ventilation. So typically a tenant spends about 85% of their costs on salaries compared to 10% on rent and 1% on energy. So the issue of sick buildings becomes more prevalent as we find that the average American spends up to 90% of their time indoors, where inhalation exposure is continuous, and our largest exposure to pollutants, both indoor and outdoor, occurs indoors. There's been a study performed internationally that shows that for every change of 1 degree centigrade, one degree centigrade, we experience 1% increase in productivity for every decline in 1 degree. Why is that? People in cooler environments have higher cognitive levels of function. So we need to make sure that we're preparing our spaces for the productivity of the tenant. So while they're spending 10% on rent, if they're able to make their workforce more efficient and get more out of them, that hits their bottom line in a bigger way. So,
But here's a question.
Yeah.
We want to update these properties. We want to do some unique things, but somebody has to pay for it. Okay. You know, many of these protocols and the changes and, you know, the environmental things are expensive, coupled with, as you and I spoke the other day, the cleaning bill is up. The, you know, the spraying of the areas are up. You know, the elevators have to be sprayed all the time. Who's bearing this, and how are your company and your friends taking care of this? Are you passing this on to the tenants, or is it being shared partially by both of you?
It's borne by both of us. You know, there are higher marginal costs for more efficient green construction and refurbishment projects. Design costs are about 1/3 higher than the cost of conventional building design. Fittings and finishes are about 30% higher. Construction costs for the highest rated green buildings are about 30% higher on average, depending on the spectrum of greenness. And green buildings take about 11% longer to complete. However, health certified spaces transact between 4 and 8% more per square foot than the nearest non-certified neighboring peers. So this premium for healthy spaces is independent of all other factors, such as building age, renovation, lease duration, and submarket. Property owners are also seeing changes in lease terms. So as we, you know, look to make lease provisions more complicit with improved property design, we will probably see lease provisions address energy specific requirements, including energy consumption, temperature set points, equipment maintenance requirements, hours of operation, et cetera, and cost sharing. So if the average life expectancy of a company from birth to its expiration is 7 years, and 52% of the 2000s Fortune 500 firms are no longer listed, how will commercial real estate leases adapt to the fact that their tenants may not survive as long as the leases that they sign? So we're going to aim to reduce the fixed commitments, increasing break options, the possibility of subletting, in spite of potentially less attractive financial conditions. There's also going to be a technologization and digitization of the buildings that will reduce the cost of something like cleaning. So for example, let's say you adopt a roboticized cleaning. You're going to see an increase in sensors in properties that can track the flow of people and employees throughout the office space. Cleaning should be based on flow, not general size. So if a certain floor is densely occupied, or a certain portion of a floor is densely visited and populated, then that should get more cleaning attention than something else. So if cleaning will become more efficient, and that goes for other types of technologies in buildings as well. It goes to sustainability, building health, and building wellness.
You know, you're talking about where your properties are. I didn't hear Lower Manhattan. What's your thoughts about Lower Manhattan?
I mean, it depends on the basis, right? You know, a lot of the buildings are, and we're basis buyers, we're less driven by IRR because we can arbitrage time because we're patient. But, you know, we've seen a few properties that we've liked off market, but, and, you know, I sit on the Rebney leasing broker calls that are pretty much weekly. And the main areas that I see tenants demanding space or looking at space, and again, there are about 8 million square feet of tenants in the market. A lot of them are looking in, surprisingly, well, not surprisingly, Hudson Yards in Midtown East, like Park Avenue, surprisingly financial district. So it's actually been leasing up well, despite the lack of proximity to great transportation hubs like Grand Central and Penn Station. And I think the reason for this is post 9/11, downtown really became a 15-minute city. We saw a rezoning of a lot of properties so that they could become residential. And I think that's something we need to see going forward, such as the Soho NoHo rezoning and maybe something in the Garment District as well, to create more 15-minute cities where people can live and work.
Well, with regard to that, what's your thoughts about the conversion of office buildings to residential rental apartments or condos like the 421Gs, which Giuliani put into effect, in the 1990s when there was difficulty for Lower Manhattan. This would probably be more for the C and D buildings as opposed to the A and B buildings.
Yeah, I think conversions are, look, I think a lot of like the Garment District, parts of Soho NoHo should be ripe for conversion to residential. I sit on the board of Habitat for Humanity and am obviously a big advocate for affordable housing. We own an 8-acre industrial site with a 300,000 square foot warehouse in the Bronx with Square Mile, and that property is getting rezoned to build 1.5–2 million square feet of resi. I think we have a strong need for residential because a lot of people have left the city, and now the resi market is back to 2019 levels in terms of concessions and velocity of signing deals and occupancy and rate. So I think that we need more housing in the city, and it's just a matter of basis. Can you buy it at a low enough basis to convert an office building to residential? It's a heavy lift from an infrastructure perspective.
In addition to the heavy lift, the requirements for ADA and other health requirements over there are difficult.
Totally different. And I think hotels that are in distress that may be too conference oriented and maybe conferences don't come back in scale the way they were, they'd be ripe for renovation and reuse as dorms because they're, similar uses, if you will. But I think there will be a lot of adaptive reuse. We're seeing, some buildings, some of the new construction even. Look at Rabina Properties' site on 42nd and 5th, where they're going to combine office with resi, high-end condos. We're seeing it, a lot of the new developments do a mixed use. So I think that there's definitely demand for that. I just, the reality is that it's expensive and you have to have a low enough basis to do it.
When we talk expensive, one of the areas which is really the hot market with limited amount of space availability is the life science. Well, I know you're involved with life science, so why don't you tell me a bit of what you're doing in life science and your thoughts for the future in life science?
Sure. So New York City's life science market is give or take 4 million square feet. That is about 10% of Boston's. We have more degrees in science-oriented areas than like any other area except for parts of California, and yet we have a tiny life science market. Our 300,000 square feet at 525 West 57th is designed for life sciences. It's been that way since we purchased it in 2005. It was originally a Potamkin dealership, so it has really heavy floor loads. It's M-zoned. It's got lots of freight capacity, and 2 of our existing tenants since 2005 are life science tenants. So we've already proved the concept. One has an active vivarium. We have 200,000 square feet. 100,000 is now recently accounted for through a recent lease we signed. Of the remaining 100,000 square feet with 50,000 square foot floor plates, it looks like we're close to signing something. We'll see. But this is a space where the equity was chasing the product before the fundamentals arose robustly. We're starting to see demand grow. So normally in a life science market, you have this, I'll take a step back. historically CapEx and R&D was performed by Johnson and Johnson, Novartis, the big guys. Now you look at R&D and it's actually spent by VC-backed startups, and then those are bought by Johnson and Johnson and the likes. So when you have a VC-backed startup, it needs about 1,000 square feet in a place that like Alexandria offers on the Far East Side. Now, the alternative is you have hospitals that need 200,000 square feet. But what that graduation space market, that once a startup hits certain milestones and gets FDA approvals, it has to find 15,000 square feet, and it needs to be in the space, whether it's $70 a foot or $150 a foot, because it has to meet certain milestones by certain dates. It doesn't matter, the almost inelastic to pricing. There's not that much of that space available. We were excited because our 50,000 square foot floor plates can be easily subdivided into 15 and 35,000, allowing for that graduation space tenant to take a 15,000 square foot lease and expand into 50,000 as they grow. This is a space where it's a build it and they shall come kind of model. A lot of the tenants don't forecast their demand going out a year. So it manifests itself more in immediate, I need this many square feet now or in the near term.
So, but here's the question. If the space requirements go up because they've reached a new plateau, accomplished something in the life science, and the space isn't available, okay? Because you're a landlord, you really can't keep the space on the market without any revenues. It's a catch-22.
The other catch-22 is that you're spending $450 a foot in TI to build out the space for either, if you don't have an incubator, master leasing the whole building, you're taking tenant risk on a company that wants a 3-year lease. And it's, if let's say it's 15,000 square feet and you're building it out for $450 a foot, you don't want a 3-year lease, because even though a lot of people say if it's thoughtfully designed, then the $450 you're putting in will outlast the tenant's lease term, because there are a lot of redundancies in tenant spaces, such as vivariums and the ratio of lab to office space and all that. There's a risk that we don't know how to underwrite the pipeline of a biotech startup. That's not, that's above my pay grade. So that's why you see a lot of the bigger firms like Nuveen, like TPG, taking a view, or Blackstone through Biomed, taking a view on companies' pipelines, and therefore knowing who to back, who to, take as tenants and who to kind of push away. So
if we're talking about a $400 a foot, TI, and can be even higher over there, what is the traditional rents that you're charging right now for a life science space?
So we've seen rents underwritten anywhere between $90 a foot triple net and $140 triple net. Usually what landlords have been doing, and Taconic did this, is subsidizing. There's a campus effect. So tenants in the life science space like to be around other tenants in the life science space because of collaboration and creativity that happens serendipitously in the building. So what we're seeing is landlords subsidizing the building or taking a cheaper lease, doing a lower rent deal to create the campus effect. So they have the life science presence, and then using that to attract and draw other tenants who are willing to pay higher rents.
So,
but I'd say it's about $110 triple net market. But again, you have to account for that $450 build out cost.
So now I'm going to turn it around a little bit. How about the idea of co-working or flex space in the life science world?
It's interesting. I mean, that's what incubators do, right? Like the incubators, like one just signed in Long Island City. They're essentially co-working for life science tenants. So, the goal is to either lease to an incubator, but to be the operator of co-working for life sciences requires that you really thoughtfully have to understand the architectural and physical requirements. Are you doing 30% office, 70% lab, 50% office, 50% lab? Is it wet lab, dry lab? Is it vivarium for big animals or just, fruit flies? So it really varies on the specific tenant. So I think I am too risk averse to be in the space of operating a co-working for life science tenants, but in concept, it makes sense.
What about with regard to that? I mean, the city has put the city and the state are putting $1.5 billion into life science. What about the cost segregation for a landlord on the work that they're doing on their buildings, so they get certain tax advantages?
Yeah, I mean, that money is going to the life science tenants. It's not going to the landlords. But what we are seeing is the emergence of federally funded finance programs like CPACE, where even though the build out is specific to the tenant, if a lot of the investment that you're in CapEx you're spending is for upgrades to the property to improve its sustainability, for example, HVAC, windows, and HVAC is a huge piece of the life science cost, then you can get 100% PACE financing subject to lender approval, and it doesn't count as a loan. It counts as a tax lien. And so it has to be paid over 30 years. And it's very attractive financing. The rates are coming in because it's become more popular and more competitive. So even though New York has a big effort to support the sciences, which I'm really grateful to the EDC for, I think from a landlord perspective, we benefit from programs like financing.
Okay, here's a question with regard to the boroughs and the opportunities. As you said, your company has been in the Bronx for many years. You've been in Long Island City for many years. Where do you see the opportunities for an investor today? I mean, one of the areas that had been done quite a bit over the past years is the conversion of industrial properties to office space. On the waterfronts in Long Island City, Brooklyn, Bushwick, and so on. That's changing now. Okay, why is it changing, and what do you see as an opportunity?
So in 2003, Mayor Bloomberg rezoned 200 square blocks that were industrial to resi and other uses. So that's what you're referring to. I used to live in.
I'm really referring to the conversions of like the Whale Building in Brooklyn.
Yeah.
Okay.
So the Whale Building, good example, industrial to office.
Correct. That's what I'm talking.
Demand for office in the boroughs is not as deep as a lot of the recent investors have expected. So whether you're talking about Paragon Building, Austell Place, Union Crossing, these buildings are beautiful and they could rent for $100 a foot if they were in Manhattan. But the demand is limited to nonprofits and government tenants and is therefore pretty, it's just a shallow market. So a lot of landlords have over-improved their properties and are asking rents that are too high for these types of tenants to pay. So even look at like 25 Kent in Williamsburg. It's done some leasing, but it has yet to really do a lot more, like significantly lease up the property. Office is tough to lease. We own a building on 41st Avenue, right next to the train, right next to the Queensboro Bridge in Long Island City. We went in at $190 per square foot as our basis, thought that it was a flex / warehouse building, historically for like costume designers, where, for example, we have like Radio City stores, their Rockettes outfits. We thought that would be a TAMI building. We thought tech companies were going to move there and it would be great for conversion to or an upgrade to office. And what we've seen is that the demand is still the hyper-local tenants who aren't going to pay $30 a foot, but rather something slightly lower.
What's your thoughts about certain areas of Harlem?
I think Harlem is another great emerging neighborhood. we don't have a presence in Harlem, although we did in, the early 80s. It's an area that's both gentrified and grown, and the gentrification, obviously is not a great thing, but at the same time, we're seeing investors buy a lot of property out there, or in Harlem, because they see opportunity in either purely affordable housing or 30/70 affordable housing. And for office tenants too, we're seeing interest around Columbia University, retail around Columbia University, and it's another growing area.
Okay, so you bring up the retail, which it's not the topic of the discussion, but I think it has to be brought up. What's happening with the retail in your buildings, the ground floor retail that you may have in certain buildings? Because I remember you had certain restaurants like in in your main areas. Okay.
Yeah, I'm sitting in my office today. At the base of the building, we have Hill Country Barbecue,
That's right.
who extended their lease during COVID. So we've been lucky to see limited retail distress within our portfolio, but that does not speak to the overall New York City retail market, which is struggling. But look, Rolex just announced that they're going to demo their building and build a 200,000 square foot building that has retail at the base. So we saw Uniqlo buy buildings in Soho. And so there is demand. I hear from retail brokers that it's on the rise. A lot of retail is just going to have to be both reimagined and repriced. So some retail is turning into micro fulfillment centers. We see GoPuff, Gorillas, 15 to 20-minute deliveries, all these companies that have north of $1 billion valuations opening sometimes up to 200 stores in Manhattan a year. They're dark stores. They don't have pretty storefronts, but they're taking retail spaces of 5,000 to 10,000 square feet. And what you see is, we also see cloud kitchens taking retail space. And the reason for that is they can't be on the second floor if they have 500 to 1,000 delivery workers coming in every day through the elevators. They need to be on the ground floor. So retail really does have a use. It'll just be repositioned, reimagined, and repriced. The days of $3,000 per square foot of rent, maybe 300 or 400. We signed a retail lease in Soho during COVID, and we were pleased with the numbers that we got. So
what's your thoughts of conversion of retail space and other space into industrial space? Like the Orbex building, which is a perfect example, on 34th Street, was a department store, and basically it's a distribution center for Amazon.
Yeah, I think it's viable. You just have to think about a lot of factors that are technical and idiosyncratic to industrial that may not make it possible. So for example, ingress, egress for large trucks, ceiling heights, loading dock space, the impact that the traffic will have on the immediate area. But what we are seeing, however, is some grocery stores are converting to 70% fulfillment, 30% consumer facing. So the fulfillment is obviously the industrial component. There have been companies that try to convert garages into industrial. An issue you face there is ceiling heights and limited number of vehicles that can enter and exit at the same time. But if you look at malls, for example, a lot of them save co-tenancy agreements that may prevent the conversion are good candidates for conversion to industrial.
With regard to that, do you have, besides Hill Country, do you have other restaurants as tenants in your buildings?
I'm trying to think. We have a few retailers. We're more biased toward retail. So for example, Foot Locker has their headquarters in New York City. It's multi-story at 1460 Broadway by Bryant Park on 41st Street. That's been performing well. Although like everyone else during the period when everyone wanted rent concessions, they were not shy about, trying to get a rent concession. My background is at a hedge fund, so I can look at financials of a company. I saw that they were highly liquid and could, had a great deal of cash. So that conversation, was more of their sense of maybe entitlement. I don't know, but I see, a lot of retail is open. Like Target has opened over 20 stores in the past year in New York City. Will that translate to industrial demand? Probably.
I mean, Target and Trader Joe's,
Trader Joe's.
there were major expansions over there. And as you said, the gorillas and the other 15-minute delivery, they're saying I can get my bananas in 15 minutes over there as opposed to going into the supermarket or something like that. We're very close to 12 noon, and I know there's a session going on. And I'd really like to thank Andrea for her insight on the office market and other characteristics. Anthony?
Wow, guys, you guys want to go for another 2 hours? I could cancel those other lectures.
No. Andrea's probably doing another webinar now.
Yeah, I have like 3 more today. So.
Oh man,
no, I'm just joking. I have to do real work too. We're trying to buy buildings off market.
You guys are great together, really. You got Michael still the pro. Andrea, you're amazing to listen to, really knowledgeable on your field there. Once again, thank you, Andrea. And if you have more questions for Andrea, we will be sending out a note to everybody with her information where you could contact her directly. Thank you, Michael. Thank you, Andrea.
Bye-bye. Thank you.